Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides, their commentary, for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. For those following our weekly newsletter, you well know we've been on a number of market themes for a while now. First is the economic reporting from the Bureau of Labor Statistics, or simply the BLS, which has become, in our opinion, nothing more than a vehicle for political manipulation and distortions in the labor market, seriously hiding the rapidly decaying U.S. economic situation. This became highly blatant as we continuously reported examples since the beginning of this year. Then on Friday, the labor report abruptly came clean for some calculated reason and threw the markets into panic, convincing everyone the Fed was now 100 basis points behind the curve. Secondly, the critical importance of the Japanese carry trade in its support of U.S. Treasury bond demand, as China and other countries have stopped buying U.S. Treasuries. Last weekend, we continued with this in talking about the problems in two sections of our weekly newsletter entitled, one, a looming Japanese fire sale of U.S. Treasuries, and secondly, the Bank of Japan raises rates and reduces the JGB buying. This Monday morning, as we sit down to put together the August LONGWave video, we suddenly find the world in the throes of a full-scale scare, bordering on panic, frankly, in Japan, and certainly forcing massive margin covering and global portfolio movements, all apparently stemming from the destabilizing shock of Friday's labor report. Who would have known, right? Therefore, it seemed appropriate to once again talk about Japan, the Japanese carry trade, and what it is likely to mean to the U.S. consumers going forward. As such, I want to discuss the subjects outlined here. I think the balanced thinking of Bloomberg's John Other's perception of the opening drama in Tokyo markets is a good way of beginning, as he best thinks of it as chaos theory at work. And to quote him, a butterfly flapping its wings in Wall Street, with some help from Warren Buffett, the Federal Reserve, and innumerable retail investors, has created a Tokyo typhoon, or morphed into a giant market-destroying Mothra, if you're a fan of Japanese monster classics, end of quote. To explain why, he suggests, and I again quote him, we must start with the expectations embedded before prices started to churn. The July survey of global fund managers produced by the Bank of America showed high confidence in a soft landing for the global economy, expected by 68%. The chance of a hard landing was simply put at only 11%, although this did represent a rise from earlier in the year, end of quote. For financial markets, that confidence in a soft landing created the risk of a hard one for prices, which now seems to be happening. While the consensus was running on the notion that any slowdown would be a gentle one, the idea of an economic weakening was taking hold. The proportion expecting a strong U.S. economy in the next 12 months dropped to a 7-month low. Meanwhile, U.S. data has been disappointing prior expectations for a few months now, a trend that reached its worst early in July. Shown here is the widely followed Economic Surprise Index maintained by Citigroup. 2 weeks ago, we detected the early shift in attitude towards no recession in its belief that we would face a hard landing in the following fashion as shown here. The market was indicating an increasing shift to a potential soft landing scenario from a no landing growth scenario. The U.S. shift is confirmed by key measures shown in the dotted box. We wrote at the time, and I quote, it's increasingly hard to see the recipe for cyclical reacceleration with China export focused and domestically slowing, peak U.S. capex, slowing consumer spending, still high real rates, slowing fiscal impulses, and a global uncertainty into the back half of the year due to U.S. election. The likelihood of a soft landing for the economy and preserving U.S. economic exceptionalism would be considerably higher if the Fed were not encumbered by an outdated inflation target, an ill-suited monetary policy framework, and overly data-dependent mindset. Instead, the probability is only in the 50% range in my assessment, and that is not a sufficiently comforting level, especially given high debt, worsening inequality, and the range of non-economic uncertainties facing the U.S. and global economies. Q2 GDP and June income confirmed 2.5% real growth with 3% inflation, making a 5.3 federal funds rate too high. 4.3 is the right number, a 100-point lower amount. The markets knew it. The Fed knew it. And Powell should have signaled this in the last week's FOMC meeting, with caveats, of course, but he didn't. Critical to Powell has been whether enough cracks in the economy are evident to the public to suggest accelerating the pace of cuts. New home construction is cracking off the coal mine canary, presaging recession. Real discretionary consumer spending remains on track. The savings overhang continues, an inflationary warning for 2025. And a greater reason for lowering policy rates is structural problems with U.S. growth. Even the flows were signaling this, as shown here. Everything has been screaming that the market was completely offside on its no recession belief, except the BLS's data reports. Remember, and I've written about this again, markets always make the biggest corrections when everyone suddenly discovers a widely accepted core belief is in fact wrong. Our data, which we laid out in our biweekly market perspectives report, showed a clear picture that we were fairly assured of having a U.S. recession within the next 12 months at least. However, the magnitude of the recession was still somewhat in question. We personally believe it will be a hard landing in 2025 as the $7 trillion sugar rush ends with the hard reality of the dire situation of the U.S. and global economies is fully realized, with geopolitical tensions, trade tariffs, and social unrest compounding an already tenuous situation. With the yield curve steepening, it was signaling the strong possibility that the recession, in fact, may have already begun. In June, the retail sales indicated negative 0.68 year-over-year nominal growth, not real growth, substantially lower with inflation better than 3%. In the past, retail sales trended sideways preceding a recession, which we were witnessing, but this time seemed to be a particularly long time as we witnessed savings rates and balances plummet, credit debt rise, with delinquencies and repossessions increasing. In a nearly 70% consumption economy, this is potentially a very serious problem, all supporting our hard landing scenario, especially with a tariff war with China looming, irrelevant of who won the U.S. election. When we examined relative total returns of equities versus bonds on a log basis, then overlaid historic unemployment levels, it was increasingly clear that the manipulation of the U.S. labor numbers was a ticking time bomb. We wrote then an unemployment rate increase of only marginally higher to 4.2 from 4.1 could be a triggering event. Global PMIs, along with the ISM reports, continue to deteriorate, while Dr. Copper supported the fact we definitely had a global economic slowing as the massive fiscal impulse subsided and inflation-fighting interest rates finally began to take their toll. We are strong believers that credit always leads the market. As such, our credit measures were further confirming our findings. Our high-yield measures showed likely August completion of a corrective consolidation before prices began falling and spreads started to rise. The last time the CCC over B diverged, shown on the left, was the dot-com warning. High-yield credit has not been confirming the rally in stocks. It is warning there is a problem in the underlying credit world. The evidence was pretty overwhelming, but still not sufficient considering the amount of liquidity sloshing around in the global system. It needed a triggering event. We got it on Friday with the labor report. With investors conscious that the U.S. economy was slowing, but still retaining their confidence, Friday's unemployment number hit, and hit hard. Non-farm payrolls only grew by slightly more than 100,000, but the unemployment rate rose to 4.3 from 4.1. Even slightly above our 4.2 triggering number. The numbers came as a surprise to the market, similar to Joe Biden in his debate with Trump, when everybody suddenly realized the mental state he was actually in. The markets reacted in a similar fashion to how the Democratic Party reacted when the spotlight was focused on the reality of the situation. Action was required. What might have been a mediocre number in another context just came over as just obviously terrible, shaking everyone's false expectations. If there's one reason why the numbers were unwelcome, it's because the rise in the unemployment rate triggered the SOM rule, which we have also been writing about. SOM herself is on record suggesting that in the bizarre post-pandemic conditions, it's possible that a rule, which is based on how fast the unemployment rate is increasing, even if from a low rate, may give a false positive this time. Both the inverted yield curve in the bond market and the leading economic indicators compiled by the Conference Board, normally too close to foolproof recession indicators, have been screaming about a slowdown for the better part of 2 years. It still hasn't happened. But a new recession warning, just as the Federal Reserve decided to leave interest rates in place, even as counterparts were cutting, drove serious alarms. That alarm centers on the Fed. Traders always want lower rates. Sometimes, like now, they are desperate to avert something terrible. Over the last 3 months, expectations for cuts have steadily strengthened. Since last Wednesday's Federal Open Market Committee meeting, the bottom has dropped out of the Fed's funds futures. Over the next 4 meetings, they're pricing in 1.5 percentage points of cuts, which implies that the central bank will cut by more than the standard 25 basis points at least twice. The market suddenly believes the Fed is again, like their inflation was temporary, is behind the curve. Again, Wall Street thinking is it is likely as much as 100 basis points. The bond market is screaming at the Fed, you are wrong again. Friday was the biggest drop in the 2-year yield since December 2023. That was when Powell pivoted. And the biggest weekly drop since the March 2023 Silicon Valley bank collapse. The yield curve has disinverted. The 230s now at the steepest since July 2022. J.P. Morgan said publicly what others are all feeling. Even if the softening in the labor market conditions moderates from here going forward, it would seem the Fed is at least 100 basis points offside, probably more. That's the same number again. So we now think the FOMC cuts by 50 basis points at both the September and November meetings, followed by the 25 basis cuts at every meeting thereafter. From a risk management perspective, we think there's a strong case to act before September 18th, but perhaps Powell doesn't want to add more noise to what has already been an event-filled summer. End of quote from J.P. Morgan. Stock market volatility is back, almost topping the levels reached during the regional banking crisis earlier last year. The alarming developments in Asia can be expected to amplify nerves. The Fed will not want to admit an error or risk causing panic by cutting Fed funds before its next scheduled meeting in September, in our opinion. So life looks likely to be tough for a while. It's worth making clear for now, however, that payrolls are still expanding and the trades that have been reversed in the last few days generally looked well overdue for a correction. The concern should be whether such a sudden downdraft will create leverage losses that could cause a cascade. We don't think that's going to happen. We got close, but we still don't think that'll happen. And remember, this is the Monday when you'll be reading this much later and you'll know the answer to that. The foreign exchange currency trade looks the most disquieting, with the popular tactic of borrowing in the yen and parking in the Mexican peso suddenly down for the year. As carry trades are often leveraged, this might trigger worse to come. And that brings us to Tokyo, where the market moves have now gone far beyond a simple correction. Japan was experiencing a significant issue before Friday's U.S. labor shock. Friday brought quite a sell-off in Tokyo. Monday morning, it is delivering an extraordinary sequel. Only last week, the Bank of Japan announced that it would be halving its purchase of bonds. The discontinued policy of yield curve control, which had latterly kept the 10-year JGB yield below 1%, was well and truly over. Yet, since the market opened Friday, we've witnessed the biggest 2-day fall in the Japanese government bond yields this century. To demonstrate how this was sequenced, here is the 10-year JGB yield since the beginning of last week. The 3 rings are in order: the Bank of Japan meeting, the Japanese market's first opportunity to respond to the FOMC meeting, and the first chance to respond to the U.S. unemployment data. This doesn't mean that the Bank of Japan didn't contribute to the accident, but it does mean that other forces were at work. What were those other forces? Japanese investors love putting their money to work overseas. Combine the extraordinary performance of the U.S. stock market with a historically weakening yen, and the result for Japanese investors is fantastic, even if it does mean that Japanese companies go without needed capital. One frustrated investment banker actually complained at a Tokyo roadshow. People ask if it's time to buy Tesla, not Mitsubishi. This is how FTSE's index for the world outside Japan has performed in yen terms since the eve of the pandemic. Meanwhile, foreign investors also like borrowing in yen and parking elsewhere via the carry trade, like Mrs. Watanabe, the mystical Japanese retail investor. These people will be burned, and their actions, as they try to minimize the pain, could make the situation worse. By liquidating their foreign holdings and bringing the money home, they drive the yen up even further. Put all this together, and at the time of writing here this morning, the Nikkei 225 stock index has opened down 7%, meaning that it has shed 20%, the typical definition of a bear market, in barely 3 weeks. If there was any reason why the Japanese stock market suddenly cracked Friday morning, it's that the yen has dropped below the psychological barrier of 150 to the dollar. Dislocations this big are dangerous. When someone takes a big leverage loss, others must make forced sales in turn. What is happening in Japan markets now is more to do with the events beyond its borders. And as Oxford Economics said, and I quote them, the sudden reversal in yen, driven by a drop in the U.S. yields and the Bank of Japan's hawkish stance prevailing in its July meeting, is another idiosyncratic factor for the Japanese equity market. Though domestic fundamentals haven't changed a lot since a few weeks ago, Japan's equity market is unlikely to reverse, at least until the U.S. market calms. Jesper Cole, who runs the Japan Optimist newsletter, shows that the country is dependent on the U.S. in economic as well as financial terms. It becomes a vital market for Japanese exports. He writes, in global financial markets, all starts and ends with America. As U.S. recession risk rise, the U.S. dollar upcycle comes to an end. Cole says, don't fight it. Warren Buffett has just raised his cash holdings to an all-time high. He expects to be able to buy cheaper in the future. Japan investors will follow his lead. End of Jasper Cole's quote. The action of Japan's investors taking cover from the monstrous U.S. moth above them could cause accidents elsewhere. For example, getting out of the carry trade means selling Mexican pesos. Mexico's exchange rate with the currency of its huge northern neighbor is crucial to its economy. This is what is happening to it. This is not a case of butterfly flapping its wings in Tokyo and weakening dramatically elsewhere. Rather, Japan is being hit by the waves caused by butterflies in New York and Washington. The risk of a major financial accident is fairly evident. Stopping it will depend primarily on what happens next in the U.S. What can we conclude? The Japanese carry trade is estimated to be over 20 trillion in size globally. Nobody knows for sure, but that's the best estimate. 3.5 trillion of that is actually invested in the U.S., and 1.3 trillion of that is in U.S. treasuries, which need that demand, and certainly not any selling of it. Japan is by far the largest holder of U.S. debt and its ability to be financed. The Japanese carry trade also funds the U.S. shadow banking borrowers and the massive U.S. private equity financiers. The carry trade only works with a weak yen, a strong target currency, and an attractive yield differentiation between the two countries. The yen has been weakening with near zero bound rates, making it very attractive carry. A weak yen has contributed to a strong Nikkei equity market denominated by the yen. However, as Japan fights import inflation and a consequential wage price spiral, it has been forced to strengthen the yen, as shown here, while dropping its long-held yield curve control, which has kept rates low and attractive for the carry trade. Bottom line, will the Japanese carry be there to supply the debt demand created by an ever-increasing U.S. debt pyramid? Recently, the Bank of Japan has actually been selling U.S. bonds to defend the yen from falling in their fight against global inflation, which is washing ashore there. A country dependent on imports to sustain its value-added export economy. The bottom line is that how this is resolved is a big deal. For all American consumers totally dependent on credit to sustain their living standards, the Japanese carry trade is a pillar of that credit edifice. As I always remind you in these videos, remember, politicians and central banks will print the money to solve any and all problems until such time as no one will take the money or it is of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of fiat currencies, unsound money, political polarization, and global policy paralysis. I'd like to take a moment as a reminder, do not trade from any of these slides. They're for educational and discussion purposes only. As negative as these comments often are, there's actually seldom been a better time for investing. However, it requires careful analysis and not necessarily following what has been the traditional, true, and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2024 turn out to be an outstanding investment year for you and your family. And I sincerely thank you for listening.